After working with hundreds of federal employees, we find the numbers we're about to share very common in retirement planning. Let's assume for a moment that before you retire, you're bringing home $6,000 a month, and that is covering all of your needs while you're working. Now you retire and your income is broken down into several buckets. First, you have a federal pension that would equal $3,000 a month. A Social Security check, let's call that $1,500 a month, leaving you with $4,500 a month in income when you retire. This gives us a gap of $1,500. How do you cover that gap? Well, you can reduce expenses, you can continue to work part-time, or you can begin withdrawing from the assets you've saved over the last several decades, from your TSP or from other assets. Today we want to examine how to do that and the effects that taxes and inflation will have on your withdrawals over time. So let's jump into a few technical points that will help many of you up front. You can retire as a federal employee, both FERS and CSRS, before you're 59 and a half. A very unique opportunity here in America, and have a full pension check. If you are retiring in the year you turn 55 or older, notice I didn't say you have to be 55, but it's the year you turn 55, then you can access your TSP without the 10% early withdrawal penalty. Again, if you draw from an IRA and you're under 59 and a half, a 10% penalty will apply. This will not happen if you take from the TSP. So, hear me clearly right up front. If you're going to retire in that window, do not take all of your TSP and roll it to an IRA if you may need some of that money before you're 59 and a half. That's a great tidbit that will help you tremendously and could save you thousands of dollars when time comes. Second, not only is that a plus when it comes to the federal regulations of your TSP, there is a negative that we need to bring up. Whenever you take money from the TSP, there is generally a federal 20% mandatory withholding for taxation. Now, your federal tax bracket may be more or less than that, but they're going to mandate at least that in the withdrawal. So be aware of that. If you call TSP for a $10,000 withdrawal, you'll get $8,000, and that may or may not handle your tax needs. So, two great points that you need to make sure you're clear on. Now, let's assume that you leave your money in the TSP. That's fine, you can do that. There is no forced taking of all of your TSP funds, but there are required minimum distributions. The government will force you to take those funds from the account. So in my example, let's say you haven't touched the TSP, it has grown to say $700,000. The first year's required minimum distribution is about 3.65%. That comes to about $25,000 that must be taken out. When you take that money from the TSP, if it was in the traditional TSP, you'll then have to pay tax on that money. Take whatever's left and either reinvest it or spend it. Be mindful of required minimum distributions. It applies to everything in the TSP, even if you have Roth TSP going on. More on Roth TSP a little bit later in the presentation. Lastly, forfeiture rules will apply. This means if you do not take your required minimum distributions, there can be some bad things that happen to your TSP. That's beyond the scope of the class today, but you can find out more on the TSP's website. Now, not only can you leave the funds in the TSP, you can also take full withdrawal option. Now, the full withdrawal has 4 different components, and as I explain these 4 components, you can pick and choose any of these 4 and mix and match for your withdrawal planning. Take note, this will be it. You will not have the ability to treat the TSP like a bank. There's a great positive to the TSP in that their expenses are quite low. On the flip side, they stay in control of how distributions work, and I'll lay that out for you in the next few moments. Well, as we look at the 4 areas of the full withdrawal, first you can ask for a single payment. Again, you can get $100,000 if that's what was in the TSP, pay tax on it, and buy the boat that you wanted. Make sure you hold back enough for taxes. That can be very expensive. Be careful. If you add a lot of income in any given year to your tax return, you could end up paying substantially more tax than you would have paid had you spread the income out over several years. We've had many federal employees come and to us and say, we're just going to pay the house off when we retire and take $100,000 to finish up that debt. Well, nope, you won't take 100. You may take $150,000, $170,000 from your retirement funds to pay the house off because of the big tax bill that you may be hit with. So be careful. Make sure you understand if you take that single payment, the tax implications that will be involved. Second, you can set up monthly payments. In this case, every year you can set up so many dollars. Say you need $2,000 a month to cover your gap. You can say, TSP, send me $2,000 a month. They will begin to do that. Also, generally that mandatory 20% federal tax withholding will apply to that monthly draw. You can also transfer the money, whatever is in the TSP, to an IRA or Roth IRA if you would like, and make those motions with this full withdrawal form. Lastly, you can ask for a life annuity. I'll give you more of that in just a moment. I want to first use these top 3 areas that I've given you and give you an example of someone ready to retire before age 59 and a half. So I'll show you the way the math could work for you. Let's assume for a moment that you have $560,000 in your TSP. You're retiring at age 57 and you need to have access to some of your money. You would like some money now and you want to have growth and move money to an IRA. You can do all 3 of these things with this one TSP full withdrawal form. Number 1, determine how much money you may need to live on between the time you retire and turn 59 and a half. So in my example, we have a need of $2,300 a month for about 2.5 years. That means $69,000 needs to be left in the TSP and withdrawn on a monthly basis to avoid the 10% early withdrawal penalty that in this case, being under 59 and a half, if you pulled the money from the TSP into an IRA, you would pay 10% more in taxation. In this example, that's another $6,900 in tax that would not be needed if you just drew that money from the TSP. Second, let's say you wanted some cash now to finish paying off debts, have a grand retirement party, whatever it may be. So you take $10,000, whoop, we have 20% mandatory tax, minus that $2,000 gives us $8,000 cash now in your hand, taking that distribution. Again, same form as doing this and this third part that I'm about to show you. You can roll the remaining portion into an IRA. So if there were $560,000 in your TSP, you leave $69,000 there to draw from until you're 59 and a half. $10,000 comes to you directly. That leaves $483,000 that you can roll over to an IRA. Why do people roll money to an IRA? Sometimes it's for control, flexibility, tax planning, to have investment advisory support to make sure you have other investment options that don't exist inside of the TSP. Always be careful when you move money from the TSP that you understand the benefits, the fees, the risks, all those items need to be carefully considered when you do that. But this example today for withdrawal strategies allows you to meet your current income needs, have cash on hand, and have other investment options out there in an IRA. So also the last point of the full withdrawal is a life annuity. You can exchange all or any portion of your TSP and give it basically to MetLife as the current provider of this, and they will guarantee you an income stream for the rest of your life. Now, the one problem with that is we have to decide between, as you see on the screen, one of these 17, 18 options and determine which one is best for you. Now, I can tell you which one is best for you if you'll tell me when you're going to die. Better yet, when your spouse is going to die as well. You just don't know. And if you choose, for instance, the one that is the highest payout that the TSP sends you on those annual statements where they tell you you can get whatever the number is, $1,200 a month or $2,000 a month, if you make that election, you will get that money for all of your life. What if you retire, turn this annuity on and die? It's over. Then you can choose to leave something to your spouse, but if you do, you will get less while you're living to leave something to your spouse. Be careful with this, because when you trade your lump sum in for an income stream, you have no control. You have no ability to grow that income stream, meaning, remember, our enemies are taxes and inflation. You need the ability for your assets and your withdrawal strategies to take into account rising cost of goods, be able to handle inflation. And when you buy an immediate annuity, you don't have that flexibility. So hopefully you've seen already that the TSP is a little sticky on distribution. It can be great on contributions. You can put a lot of money in and it can grow in a very low cost environment. But when you begin the withdrawal phase of life, when you move from the accumulation stage to the distribution stage, make sure that you are planning appropriately and understand, will the TSP be able to meet your needs or not? But again, this is a great thing to have assets in a retirement fund that you get to use to supplement your income. Let's talk taxes for just a few moments. As a CPA, I'm able to assist many individuals with analyzing their tax situation. You know that most of your federal pension will be taxable, and you will get a 1099 once you've retired for that. Now also, any draws you make from your traditional TSP will be added to your income, and as we'll see in a few minutes, you may even have to pay tax on some of your Social Security benefits. So let's be careful of the total tax effect of your withdrawals as it relates to your pension and your Social Security checks and other sources of income and your spouse's income. All that needs to be piled together and looked at carefully to determine how tax situation will work for you later. Also, briefly, let's look at state income tax. I know we have people from all over the country viewing this webinar, so because I'm in Georgia, I'll use our state for example. But in Georgia, once you're age 62, the first $35,000 of your pension income is not taxable here. That's your federal pension, your IRA, your TSP. None of those things are taxable on $35,000. And once you hit age 65, the first $65,000 is not taxable in Georgia. Now, there are 50 different ways that income tax works in the 50 different states. So make sure you understand the pros and cons of your state and the effects that they will have on you when you retire. Go into that with your eyes wide open so that you are an informed consumer and you know what your bring home pay will be when you retire. Isn't that what we want to know? Are we going to be able to cover the gap and have sufficient bring home income to keep our standard of living at what we've enjoyed the last several decades?